Right. Let's look at this chart. We are today at the beginning, right? And the end of the period is, let's say, at the end of 1 year, at the end of one financial year. The sales of the company are where it is shown on the sales axis. That's where the sales are. Now, the company is continuously losing market share for a variety of reasons. And because of that, the company projects that if it goes on as it is today, then at the end of the year, the company's sales would be at a lower level, right? And that's what F0 stands for, right? That's the sales at the lower level. The company has a target that the sales must reach the upper level, right? Which is, we are talking about, let us say, a 10% improvement on the present sales. Whereas the company projects that if it continues as it does today, there would be a 10% decline in sales. So this 20%, right, between F0 and the target is the sales gap. Now, how are we going to bridge this gap? One way of bridging it would be to look at the market segments where the company is strong and to try and increase its market share in those segments, either by breaking those segments down further, refining the understanding of the segments in such a way that product customer aspirations of the product are better met. So, one way of filling the gap, in fact one major way of filling the gap, would be by market penetration. Now, what about market development? Here we are saying that today the company focuses on certain segments of the market, right? Why not look at some more segments which the company has not touched at all today? Then sales in those segments would add up to bridge this gap. So that's market development. Then you have product development, where the company looks internally and finds that it is in 2 or 3 types of that particular product, 2 or 3 models of that particular product. But that product, there are, let us say, 10 models of that product available in the market, and the company has not moved to the other 7 models. So the company can expand its product presence from 3 to 7, right, and bridge the sales gap. Finally, the company may decide to use its competences to make a new product altogether, right, or to address a new market altogether with this new product, right. This is diversification. Now, each one of these methods will help the company to fill the sales gap. So, bridging the gap is the technique of gap analysis. This technique forces the company to understand what the gap is and forces the company to think in terms of how that gap could be bridged. This is another technique which is very, very powerful. This is the technique of analyzing competitors, right? Now remember, we are looking today at the issue of strategic positioning. That is, we are looking at the issue of how does the company come up with strategies. Now, One way was SWOT analysis technique, another way was the gap analysis technique. Now, looking at competitors, competitor analysis is another way in which strategies can come up. For instance, let's look at the first technique of monitoring competitors, right? Monitoring competitors, see, very often companies are blind to competitors. Companies are so focused on their own issues that they are blind to competitors that are coming into the market, that they are aware of long-standing competitors, but they have very little idea about competitors who have newly entered the market. Once you monitor competitors in depth, the next step is to understand the competence of those companies. We are talking about companies who were not present in the market earlier, who were not present in that particular market earlier, right? Therefore, it is quite likely that the company's understanding of that competitor is low. The company does not really understand what is that competitor's major strength, right? What is it that drives that competitor? What are the corporate objectives of that competitor, right? Now, understanding these is the next step. And the third step is, having done this, to target the competitor through a strategic measure within the company. So, this is another means by which a company can generate a strategy, right? Look at new competitors, understand these new competitors, and use that understanding to create a strategy to attack that competitor. Now, let's take the instance of a company like Nokia, right? Now, Nokia was the world market leader in mobile phones, mobile handsets. It was the world market leader for a fairly long time. Then, when smartphones came into the market, and companies like Samsung, who had focused on this the smartphone segment of the market, when companies such as Samsung entered India, for instance, Nokia in India found its market share going down and customers switching from Nokia to Samsung. Now, Nokia, when it first entered India, let's say 10 years back, 12 years back, for mobile handsets, at that point, it had not considered Samsung as a potential competitor at all, because Samsung was not a major presence anywhere in mobile handsets, and less so in India. So, Nokia India had no reason to concern itself with Samsung. But Samsung increased its presence in the Indian market through its emphasis on smartphones. This was a strategic initiative of Samsung which was missed altogether by Nokia. Ultimately, when Nokia started losing market share in India rapidly, and like in India, in other rapidly growing handset markets, when Nokia started losing its market share, it switched. It began to lay increasing internal emphasis on smartphones. So, this strategic move by Nokia was a direct result of its analysis of a competitor, Samsung. That's competitor analysis.